A buyer CPA can find more problems in your financials in 2 hours than you've noticed in 10 years. And every single one of those problems has a price tag attached to it. The moment your financials land in front of their CPA, the judgment has already started. Are the books clean or messy? Are the numbers consistent year over year? Does the tax return tell the same story as the P&L? Is there a compliance issue sitting in here that we haven't found yet? Every answer to those questions either builds confidence or builds the case for them to pay you less. This video covers both sides of that equation, financial cleanup and tax compliance, because they're two versions of that same problem. Your numbers need to hold up before a buyer ever shows up. Here's what clean books actually mean and the 5 steps to get there. Step 1, reconcile everything. Every bank account, every credit card, every line of credit. If you have accounts that haven't been reconciled in months, transactions sitting in clearing accounts, duplicates, anything unmatched, that's where you start. Unreconciled accounts don't just look sloppy. They make buyers question whether the financial picture is accurate at all. Step 2, standardize your categorization. Pull your last 3 years of P&Ls and look at how you've categorized expenses. Vehicle expenses 1 year, auto expenses the next, transportation the next year. That inconsistency breaks the trend line. Buyers are trying to read it. They look at 3 to 5 years of data to understand performance patterns. If the categories aren't consistent, the pattern is unreadable, and unreadable financials get discounted. Step 3, separate personal from business. If you've been running personal expenses through the business, and most business owners have, those need to come out of the normalized financials going forward. Personal vehicle, cell phone, travel, meals, insurance. Document everything, every single one of them. This isn't hiding anything. It's showing a buyer the true economic performance of the business without your personal costs mixed in. The documented version of these becomes your add-back schedule. Step 4, build your add-back schedule. This is one of the most important documents in your entire financial package, and most sellers have never created a formal version of it. Your add-back schedule is an itemized list of every adjustment to net profit that shows your buyer your true normalized earnings, owner salary, personal expenses, one-time costs, non-cash expenses like depreciation. Each line needs a dollar amount, a clear description, and documentation. You can find the add-back schedule in the Exit Ready Vault. The link is in the description. Here's why the add-back schedule matters more than most sellers realize. Your SDE is what gets multiplied to arrive at your valuation. Every dollar of add-back a buyer successfully challenges lowers your SDE. On a 3X deal, losing $30,000 in challenged add-backs doesn't cost you $30,000, it costs you $90,000 in purchase price. Buyers know this. They'll challenge every add-back that isn't airtight. The sellers who hold their add-backs are the ones who built the schedule properly and can defend every single number. If you're getting value from this, please subscribe. This is a part of my free YouTube course, Exit Ready, and I built it because I'm tired of watching sellers lose money they didn't have to lose. Step 5, align your P&L with your tax return. This is the cross-reference buyers always run. Your income statement and your tax return will almost never match exactly, and that's normal. But every significant difference needs a documented explanation. Write those explanations down. If a buyer's CPA finds a variance and you don't have an immediate, clear answer, that variance becomes a problem. Hand them the explanation proactively, and it becomes a non-issue. On timing, the same cleanup that gets accepted without question when it happened 18 months ago gets scrutinized hard when it happened 6 weeks before you listed. Cleanup that looks rushed looks intentional, and intentional looking changes in your favor are exactly what buyers probe. Start this process before you go to market. The cleanup process takes time and precision. Start now before you ever decide to sell your business. Now, tax and compliance, because this is where sellers get blindsided by things that genuinely they really didn't know were there. And when buyers find a compliance gap, they don't assume it was an honest mistake. They price it as risk. Payroll tax. This is the most common compliance gap in a small business. Payroll tax deposits, quarterly 941 filings, W-2s and 1099s, worker classification. If you've had late deposits, if you have contractors who should have been employees under IRS classification rules, buyers will find it. And worker misclassification specifically carries retroactive tax and penalty exposure that a buyer either prices into their offer or requires you to resolve before you close. Sales tax nexus. If your business sells products or services in states where you have nexus, employees, inventory, significant revenue in some states, you may have an obligation to collect and remit sales tax there. Many small businesses don't realize they've created nexus until a buyer's tax advisor looks for it. Seller ships into 3 states for 4 years without registering. Buyer's team finds it. Retroactive liability estimated at $180,000. Buyer comes back with a $200,000 price reduction. That conversation with your CPA before you list is vital. Have it. Business licenses and transferability. Every license your business holds needs to be current. But here's what most sellers don't check. Some licenses are tied to you personally, not the entity. A contractor's license, a professional certification, a state-specific operating permit. When you sell, that license doesn't automatically transfer. If a buyer can't operate your business from day one because a key license is in your name, that becomes a closing condition they're going to use to delay the deal or potentially reduce the price. Pull every license and permit for each one. Is it current? And is it tied to you or to the entity? Here's how to run your own audit before you list. Sit down with your CPA and work through all 5 financial cleanup steps in order. Then have them run a payroll review for the last 3 years and a sales tax nexus analysis for every state you operate in or sell into. Pull your license and permit list and check current status and transferability for each one. Now let's talk about the other side of this, because clean financials are only half the picture. A buyer who sees solid books and then walks into an operation that lives entirely in your head is still going to have questions, and those questions are going to cost you. Operational cleanup is not the same for every business. Before you do anything, you need to be honest about which type of business you're selling. If you're a sole operator, you run the business, you are the business, and that's worked, that's not a problem. It's actually a completely legitimate business model. Buyers know they're buying a job in some cases, and they price for it accordingly. What they need is to see that that job is learnable, that everything you do is written down well enough that someone else can do it. Don't spend time trying to hire managers, build a team, and reinvent the wheel just to chase a higher multiple unless your business is truly ready for that, meaning the revenue supports it, the margins hold up, and you have 12 to 24 months minimum before you plan to go to market. Cosmetic restructuring 6 months before a sale is one of the things buyers see through fastest. They'll ask to see your payroll history. They'll look at when roles were created. Don't manufacture depth you don't have. If you genuinely want to build toward a team-operated business, start executing that at least 12 months before you list. Ideally, 2 years. Give it time to show up in your financials and actually function. A team that's been running for 2 years looks like an asset. A team hired 8 months ago looks like a story. Now, for both types of business, here's what operational cleanup actually looks like. Start with your SOPs. A standard operating procedure doesn't need to be a 50-page manual. It needs to be specific enough that someone unfamiliar with your business could read it and do the things correctly. How do you onboard new customers? What happens when there's a service issue? How do you handle end-of-the-month billing? How does a job get scheduled, executed, and closed? Write these down. If you need help, the Exit Ready Vault has the entire framework to do this the right way. The link is in the description. Every process that happens more than once should have a document. If you're a solo operator, this is your entire product during due diligence. A buyer sitting across from you wants to see that the way you run the business is transferable, not because they doubt you, but because they need to be able to run it after you leave. Your org chart. If you have employees, your org chart needs to reflect what actually happens, not an idealized version. Who reports to whom? Who owns which function? Where does a decision go when you're not in the room? If the answer to every one of those questions is still you, that's the gap to address. And the org chart makes it visible to you and the buyer. Job descriptions. This is where most businesses have the most fiction. The job description says one thing, the actual job is something else entirely. A buyer's team will interview your key employees during due diligence. If what your people do every day doesn't match what their job description says, that's a flag. Write job descriptions that reflect a real job, every key role. Now, training. Having a process documented is one thing. Having employees who actually follow it is another. Before buyers come in to observe your operation, and serious buyers will, you want to be able to show them that your team runs on a system, not on an instinct and tribal knowledge. That means your team knows that SOPs exist, they've been trained to them, and they actually use them. This doesn't require a training department. It requires that when something gets done. It gets done the same way, consistent, repeatable, documentable. A buyer watching your team work should be able to see the system in motion. Vendor contracts. Pull every vendor agreement. Look through three things: who it's with, can it be assigned, and what are the termination terms. If a key vendor relationship is in your name personally, not the business entity, that has to be addressed before close. If a critical contract can be terminated by the vendor on change of ownership, that's a disclosure item. Find it now, not during due diligence. Customer agreements. If you have customers on contracts, pull them. Are they current? Are they signed? Are there automatic renewal clauses? Buyers look at customer concentration and contract status together. A customer who represents 25% of your revenue and is on a handshake agreement could be seen as risk, and they may reprice depending on that relationship. A customer on 3-year contract with renewal language is a real asset. Employee agreements. Do your key employees have offer letters, non-solicitation agreements? Do you have an employee handbook that lists out your PTO policy, termination conditions, etc.? If you've made verbal promises about a deal or deal compensation, a bonus, a percentage, a role post-sale, those conversations need to get in front of your attorney before a buyer finds them in due diligence through an employee interview. Undisclosed obligations become post-close liabilities. Here's the honest version of the timeline. If you're a solo operator with no employees and clean financials, you can complete this operational documentation in under 90 days if you're disciplined. That's your runway. If you have employees, managers, vendor relationships, and customer contracts, give yourself a minimum of 6 months to do this properly. A year is really better. You're not just documenting, you're auditing for effectiveness of your documented process. And what you'll find in that audit will tell you what needs to be fixed before you can go to market with a clean story. The Exit Ready Vault has the financial cleanup checklist, the SDE add-back calculator, the tax compliance checklist, the operational process documentation guide, the SOP template, and the org chart template. Everything in this video organized into a working system so you can take into those conversations with your attorney. In the next video, we're getting into personal asset protection. What's actually at risk when you sell? Why LLC protection isn't what most sellers think it is, and why the window to restructure closes the moment you go to market. The link is in the description.